Welcome to Talk Tickers. Today is January 18th, 2026, and we are looking at a financial convergence that feels a bit like a slow-motion car crash that's finally hitting the wall. The industry calls it the maturity wall in commercial real estate. And if you're listening to this thinking, I don't own an office tower, why do I care? Stick with us, because this isn't just about empty cubicles. This is about the solvency of the bank where you might keep your checking account and the credit lines that keep small businesses running.
It really is the story of the year. And you're right about that slow motion description. Unlike, the 2008 crisis, which felt like a bomb going off overnight, Lehman Brothers collapses and the world just stocks. We've watched this car drift across the center line for 2 solid years.
We knew it was happening.
We watched it happen, and now here comes the impact.
And now here comes the semi-truck.
Here comes the semi-truck.
I want to start with the sheer scale of what is happening right now in 2026. Because we aren't talking about a few bad loans here and there.
No, the scale is staggering. Depending on which data set you trust, whether it's TREP or MSCI, it is somewhere between, let's say, $936 billion and an even $1 trillion.
$1 trillion.
In commercial real estate loans maturing this year alone.
Okay, just so everyone is clear on the terminology, when we say a commercial loan is maturing, that's very different than a home mortgage, right?
Very different. If you buy a house, you get a 30-year fixed mortgage. You pay it down. Commercial real estate loans are much shorter, usually 5, 7, or 10 years. And crucially, they are often interest only. So at the end of the term, you haven't paid off the loan. You still owe the entire principal amount. That's the balloon payment.
So the bill comes due.
Yeah.
And you have to get a new loan to pay off the old one.
Exactly. You refinance, and usually that's routine. It's a rubber stamp. But the problem isn't just the volume of loans coming due. It's the environment these loans are waking up to. They were originated in a world of, near zero interest rates. Now they're waking up in 2026 to a completely hostile environment.
That sets the stage for our mission on this deep dive. We need to figure out why 2026 became the breaking point, who is holding the bag, and unpack this term I keep seeing, latent distress.
Latent distress is the key concept. It's the gap between what the financial statements say and what the reality on the ground actually is.
Before we get to that, let's look at the timeline. Why is 2026 suddenly the year of reckoning? Why didn't this blow up in 2024 or 2025?
Because the banking industry and the borrowers engaged in a very strategic game called extend and amend.
I've heard it called extend and pretend, which feels a bit more cynical.
It's maybe more accurate. Here's what happened. Back in 2024, a lot of loans were coming due, but interest rates had already spiked.
And office values were tanking.
Right. So if the banks had forced borrowers to refinance right then, the math wouldn't have worked. The borrowers would have defaulted, the banks would have had to foreclose, and they'd have been forced to record massive losses immediately.
So it was a standoff. The borrower couldn't pay, and the bank couldn't afford to admit the borrower couldn't pay.
Precisely. So they made a deal. The bank said, okay, we'll extend your loan for 12, maybe 24 months, and we'll just pray that by 2026, rates go back down, or everyone suddenly decides they love working in offices again.
They hit the snooze button.
They hit snooze. But the problem with hitting snooze is the alarm eventually goes off, and now you're even later.
And the alarm is deafening now.
It is. Rates didn't crash.
Yeah.
And because we pushed all those 24 and 25 maturities into 2026, we've created a bottleneck. The pile of debt is artificially huge.
Let's break down the math for the listener. Let's say I'm a landlord. I bought a prime office tower in 2021. I felt like a genius.
You were a genius in 2021. You bought a building for, say, $100 million. You put down $30 million of your own money, and you borrowed $70 million from the bank. Your rate was probably around 3%.
Life is good. Rent checks are clearing.
Fast forward to today. Your loan matures. You walk into the bank to get a new one to pay off that $70 million. First, the banker tells you the new rate isn't 3%. It's 6.5% or 7%.
So my biggest monthly bill just doubled immediately.
It doubled. That alone might wipe out your profit. But then comes the second punch, valuation.
Right.
Back in 2021, the bank agreed your building was worth $100 million. Today, because vacancy's up, that same building might only be appraised at $60 million.
Wait, if the building is worth $60 million, but I still owe $70 million.
You're underwater. You have negative equity.
Right.
And a bank is certainly not going to lend you $70 million on a $60 million asset. They might offer you a new loan for, roughly $36 million.
So I owe the old bank $70 million. The new loan only gives me $36 million. I have a massive gap.
That is the capital gap. You need to write a check for $34 million in fresh cash to keep your building.
And most owners don't have that lying around. Or if they do, they're not going to throw good money after bad.
Why would they? They hand the keys back.
Jingle mail.
Exactly. And when the bank gets those keys, they are now the owner of a building worth way less than the loan they had on their books.
Yeah.
That is when the loss gets realized.
That is a brutal squeeze. But we need to be nuanced here. Commercial real estate isn't just skyscrapers. It's warehouses, apartments, strip malls. Is everything a disaster?
No, and that's a critical distinction. It is a tale of two markets. If you own an industrial warehouse near an airport, you are probably doing great. E-commerce demand is still strong.
Grocery-anchored retail centers in the suburbs.
Still solid.
Yeah.
People need to buy food. But the villain in this story, the toxic asset, is office.
It's the epicenter.
And the reason is that the decline in demand isn't cyclical. It's not just a slow economy. It is structural.
Hybrid work.
Remote and hybrid work has fundamentally broken the old model. Companies are realizing they can function perfectly well with 30% less space.
We are seeing vacancy rates over 20% in a lot of cities.
And in the older buildings, what we call Class B and C office space, it's much, much worse. For those buildings, valuations haven't just dipped, they've plummeted 40% or 50%. The equity is completely wiped out.
I did see one outlier in the notes, Miami.
Miami is the exception that proves the rule. Office leasing there is actually surging. It's defying the national trend. So if you're an investor, it's incredibly fragmented.
But there's another sector I want to flag because everyone knows office is in trouble. But multifamily? Apartment buildings?
Yes. People are not paying enough attention to multifamily.
I always thought that was the safe bet. People always need a place to live.
They do. But the financing on those deals back in 2020 and 2021 was incredibly risky. There was a frenzy of syndicators buying up apartment complexes.
And they used floating rate debt, didn't they?
Almost exclusively. Aggressive, short-term floating rate bridge loans. The business plan was simple. Buy a complex, do some light renovations, raise rents by 30%, and sell for a huge profit in 2 years.
But then the Fed raised rates.
And their loan payments skyrocketed because they were floating. Their mortgage doubled or tripled. At the same time, insurance premiums in places like Florida and Texas tripled. So even if the building is full, it might be losing money every month.
And we are seeing foreclosures in that sector rising fast.
We are. In fact, some data shows 60% of those risky apartment loans from that era are maturing right now in the second half of 2026. This is sort of the hidden wave of distress.
Okay, so the borrowers are in trouble. But someone lent them this money. Who is holding the bag? In 2008, it was the big investment banks.
This is where the story shifts from a real estate problem to a broad economic one. It is not the too big to fail Wall Street giants.
Not JP Morgan.
They have exposure, sure, but for them, CRE is a side hustle. Their portfolios are diversified. The people holding the heavy bag are the regional and community banks.
The banks on Main Street, how exposed are they?
It is hugely disproportionate. Estimates vary, but regional and community banks hold somewhere between 55% and maybe even 80% of all commercial real estate debt in the U.S.
80%.
It is. We look at a metric called the concentration ratio. Regulators get really nervous when a bank's CRE loans exceed 300% of their total capital.
Meaning their exposure is 3 times larger than their equity buffer to absorb losses.
Exactly. So if that portfolio drops in value by just a third, their capital is theoretically wiped out. They're insolvent.
And many banks are over that limit.
Yes. Many are way past that 300% number, and they are fighting this fundamental battle called asset liability mismatch.
Right. It sounds like jargon, but it's actually how banks die.
It's banking 101. They borrow short from your deposits, and they lend long with a 10-year mortgage.
Standard practice.
But when rates rise rapidly, the value of those long-term assets on their books just drops. That 3% loan they made is now worth a lot less.
This is the Silicon Valley Bank story from 2023.
That's it. SVB failed because they held government bonds that lost value. The risk hasn't vanished. It has just mutated. Now, it's not just bonds, it's the credit quality of the real estate loans themselves.
This brings us to latent distress, because if I look at the regulatory filings for these regional banks right now, they look fine. Delinquency rates are recorded at what, 1%?
Low single digits. Looks incredibly healthy on paper.
So are they lying?
I wouldn't say lying. I would say they are managing the reality. Latent distress refers to loans that are technically current, but the underlying property is effectively broken.
It's a zombie. It's dead, but it's still walking.
It's a zombie. And the research suggests this latent distress is roughly 4 times higher than the reported delinquencies.
4 times?
Yes. The big banks, they took their medicine early. They wrote down the values. the regionals, they can't afford to take that hit. If they recognize the true loss, it would wipe out their capital buffer.
So they roll over the loans, extend the term.
They might even lend the borrower the money to pay the interest through something called an interest reserve. It's a way to keep the loan marked as performing.
Wow, they lend the money to pay themselves back.
It happens. It's unsustainable, but it kicks the can down the road and keeps the regulators at bay for a while.
And the stress tests are clear on this.
Very clear. If we run realistic scenarios, like a further 20% or 30% drop in property values, a significant number of these regional banks become undercapitalized. They fail.
Okay, so what? Here, if I'm running a small business in Denver, why does it matter if a regional bank gets squeezed?
This is the critical connection. The consequence is a credit crunch, and that hits Main Street harder than Wall Street.
How so?
Regional and community banks are the primary lenders for small businesses. They give you a line of credit for inventory, a loan for new equipment. They know the local market.
The big banks aren't doing those smaller deals.
Not really. A $500,000 loan involves a lot of paperwork for not much profit. So if the regional banks are fighting for survival, trying to patch holes in their balance sheets, they stop lending. They pull up the drawbridge.
So the local restaurant can't renovate.
Exactly. It starves the real economy of capital. You can't expand, you can't hire. It creates a recessionary drag that has nothing to do with how good your business is.
And there's the other layer, the cities themselves, the urban doom loop.
This is the cycle that keeps mayors awake at night. It starts with empty offices.
Right.
Empty offices mean the building is worth less. If it's worth less, the property tax assessment has to come down. In cities like New York or Chicago, commercial property taxes are a huge chunk of the budget.
And that money pays for everything. Police, fire, schools.
Everything. So if that revenue evaporates, the city has a budget crisis. They have to cut services, the streets get dirtier, crime might tick up. That lowers the quality of life.
Which makes more people and companies leave the city.
Which leads to more empty offices, lower values, and lower taxes. It is a self-reinforcing downward spiral.
And we are seeing the early stages of this now. Foreclosures are at their highest mid-year totals since 2014.
We are. And loan loss provisions, the money banks set aside for bad debt, are projected to rise to 24% of net revenue this year. A quarter of their revenue just gone.
Is there any good news? Is anyone buying these buildings?
Actually, yes. Transaction volumes are finally ticking up. The distress is finally being realized.
The Band-Aid is being ripped off?
Exactly. Investors who've been sitting on cash for 3 years are finally swooping in. They're buying these assets at deep discounts, 50, 60 cents on the dollar.
The vultures are circling.
The vultures are feeding. But in finance, vultures are necessary. They clear the carcass. This price discovery, as painful as it is necessary for the market to reset and find a bottom.
So, to recap, we have a $1 trillion maturity wall. A banking sector that's been playing extend and pretend, and latent distress hiding on balance sheets that is 4 times worse than what's being reported.
And a reckoning that can no longer be postponed. The bill has come due.
It is a sobering picture. As we close out, what's the one thing you want our listeners to be thinking about for the rest of 2026?
You know, we spend so much time focused on the banks, but I want you to think about the cities. If 2026 forces a massive structural repricing of our city centers, we aren't just looking at a banking issue. We might be looking at a fundamental redesign of how American cities fund themselves. If the tax base collapses along with the office towers, who pays for the recovery? That's the real question.
If the skyscrapers don't pay for the subway, who does? Thank you for guiding us through this. And thank you all for listening. That's it for this Talk Tickers Deep Dive.